Hey everyone, this is Tyler from Macro Ops presenting this installment of the Market SitRep titled Pushing on a String. So I know everyone's been buying their favorite penny stocks and watching the breakouts rip to the upside, but that fun is about to end and the dominant fundamental bear narrative is going to return. So we're going to touch on a few points here. We're going to talk about macro, Super Mario, what he's doing over there at the ECB, the possibility of a United States recession, and finally finish it up with some price charts. So let's get into it. So our current global environment, all developed markets are in the early stages of deleveraging as part of the long-term debt cycle. And the US in particular has increased its official credit outstanding by 58-fold since the 1970s. Now here's a graph of United States debt to GDP, and you can see that we're way at the top, over 300%, even up in the 350% range right now. And we have a long way to come off. And we've built up all this leverage since the 70s because every single time we have a downturn, the bankers stimulate. We all take on more debt and we continue to kick the can down the road. This thing cannot last forever, and eventually the levees break. So emerging markets, they're at the beginning stages of a cyclical short-term deleveraging. So they don't have as much long-term debt built up, but they're still reaching a short-term instability period. And China's somewhere in between developed markets and the emerging markets. So China's beginning deleveraging from a very over-leveraged point in which massive amounts of debt was accumulated in a very short time, but they haven't been going through the cycles for as long as developed markets have, so they don't have as much long-term debt built up. So here's a Ray Dalio debt cycle graph overlaid on the productivity line. I want to show you guys to illustrate what we're talking about. So the developed markets, including United States, Japan, Eurozone, they're near the end of that long-term debt cycle. Okay, and not many people understand what a long-term debt cycle is because it takes 70 to 100 years to play out. But they're right there at the end where we've built up so much debt, and because we have no more room to stimulate anymore, i.e. interest rates at zero or negative, when a next downturn comes, we can't kick the can down the road any further. China is a little bit further back, and they're still at the peak of one of these short-term cycles, but they don't have quite as much leverage built up as the developed markets. And then emerging markets are back further, where they're still at the peak of a short-term cycle, but they're not as far along in the long-term process as the developed markets. And now, this is why we call this installment Pushing on a String. This is the theme here in the world. Japan, Europe, and the US, through monetary policy, interest rates, and QE, they've reduced the spread between cash and financial assets to the point where it can't effectively be narrowed. Okay, there's just no more left. There's no more juice in the tank to help out the economy when it starts to get sick again. This negative rates, additional QE, and other monetary policies aimed at investors have lost their efficacy. So debts to incomes are simply too high, and they need to rebalance. That's all there is to it, guys. At some point, you have so much debt over your income, you can't handle it anymore, and the banks can't save us anymore either. So what do? The opposite of what we should. All right, so we're increasing debt around the world, and the central bankers are helping with this as well, being more stimulative and lowering rates even more to try to induce this practice that's going to end up really killing us in the long run. And trade and growth slowing. So we need to decrease our debt and increase our income. But what we're seeing in the data is the exact opposite. We're increasing debt and decreasing income and decreasing growth. It's a very bad cocktail right now going on in the world. Now, we also got negative rates out there. So if you look at the graph on the left, $7 trillion of negative yielding bonds. And this is what the central bankers think can help stimulate us, because they think that if the rates are negative, that's going to help out with debt servicing costs, people can borrow more. But what we're seeing is that's not working. It's not stimulating the economy. And it's actually setting us up to be extremely vulnerable in the next downturn. So just check this out here. Because of the policies, a Japanese 40-year bond yields less than a US 2-year note. Just let that sink in for a second. A Japanese 40-year bond yields less than a US 2-year note. And this is where the central banks are heading for the rest of the nations too. Like, how would you feel if this was coming to the US? How do you think Europeans feel right now with their NERP and negative interest rate policy pushing this kind of phenomenon in their fixed income markets? So not only are the central bankers being extra risky and continuing to keep policies very stimulative instead of taking the pain that needs to be taken, which is reducing the debt burden, they have decided to basically rob savers. So you can't earn any more money by stashing it away. I mean, think if you're a Japanese citizen and you want to earn some interest rate on your savings, 40 freaking years, you earn nothing, next to nothing. So let's wrap all this up. Why do we care about the high debt loads? Why do we care about the long-term debt cycle? Why do we care about the central banks doing their reckless policies? And why are we so scared about the next slowdown? Well, the reason being is debt servicing costs become unbearable and there's very little room to lower the cost of debt again. Okay? And typically what happens is you have the scale here of debt to income. When we start to have a slowdown in income decreases, the central banks help this phenomenon by lowering interest rates and reducing the debt burden. Well, guess what? Now that we're already at the zero bound or negative in most of the developed markets, when we fall again, there's really nothing the central bank can do. They have very, very little effective tools left in their toolbox to help this balance. So what happens is there's the only way to get rid of it is to drastically reduce the debt, which means defaults, restructuring, etc. And you have to get the scale debt to income balanced out over time for long-term economic health. And that's just not where the central banks and the governments are leading us right now because they're so short-sighted on their own election cycle or their own tenure in office. They don't think long-term. And Super Mario Draghi, leader of the ECB, he is doing more of the same. And we just saw him in the latest meeting continue with these destructive policies. So he's still trying to kick the can down the road. And he's still trying to keep everything together. And you know what? Because that's all he can do. What is he going to do? He's going to be the guy that takes the pain for everyone right now and be the guy that does what needs to be done? No, that's not how these guys work. So he's going to continue to be stimulative. The latest meeting was on March 10th. They expanded QE in the Eurozone from 60 billion a month to 80 billion a month. And they expanded this buying into corporate debt even. So they're just slowly taking over the whole market to do whatever they can do to keep things from falling apart and deflating over there. So the ECB went more negative on their deposit rate to negative 0.4%, so deeper negative interest rates, robbing savers even more. And the benchmark rate was lowered to 0%. But the market basically gave a big FU to Draghi, and the Euro USD rallied hard. So typically you would see Euro USD weakening during announcements such as these because lower rates, QE, etc. is supposed to weaken a currency. But this is exactly the opposite of what happened. So the market's just fed up with all of it. Completely fed up with central bank policy, and you're seeing pushing on a string manifest itself in the real. So pushing on a string, these policies don't have any more marginal benefit to the market. And the market is telling the central bankers, no, they don't have any more benefit. Stop doing them. So we saw this with Kuroda after Japan went NERP. We saw the yen dramatically strengthen when he wanted it to get weakened. And now we're seeing it again with Draghi. So the message is pretty clear here, guys. Further easing is no longer effective, but these guys don't listen. They don't care. They'll continue kicking the can down the road and doing everything they can to make sure these markets don't tank while they're in their tenure in office. So let's move on to the United States and look at the possibilities of a recession here. So growth's meager. U.S. has gone a record 10 straight years without 3% growth in GDP. Not many people know that, but it's been fairly stagnant over here for a while. The ISM manufacturing number, the number we really like to use to determine where we are at in the business cycle, is below 50. That means we're contracting. And non-manufacturing PMI is tanking. These indicators are very forward-looking And you can see in 07-08 period, they predicted the great financial crisis. And also in the bear market 2000, 2001, 2002 era, they were below 50 as well. So when these indicators are below 50, it's a watch out mode. And finally, our distressed debt ratio is highest since 2009. And you can thank this to the energy patch, but we're not exactly the most healthiest we've ever been right now. Very, very vulnerable. So we got high prices in the S&P. We got tanking high yield credit, along with a bunch of forward indicators telling us that we're contracting and going to recession. But the stock market still won't fall. And eventually these two things will converge. So you can see here high yield and high yield CCC and lower typically track the S&P pretty well. But now we have a huge divergence where the SPX is near all-time high still, and high yield has sold way off. So one of these is going to meet the other. Either the SPX is going to come down hard or high yield credit's going to rally hard. And considering what we see in the oil patch right now, we don't think that's going to happen. We think that's going to have knock-on effects to other industries, banks, etc. And we're going to see the S&P fall to meet the high yield credit line. So in conclusion, there's just tons of downside risk with little to get excited about in the upside for equities. It's that simple. So they're just not a good buy right here. And in fact, they're probably a good short. All right, and we're going to begin the price action portion of the presentation with our favorite SPX weekly. Now we've rallied pretty hard off of the double bottom lows right into this resistance area. And we expect just some more sideways chop here before next week's central bank meeting where we plan to get short and ride this sucker back down to prior lows and possibly break those lows and continue down into the 1600 range. We're pretty bearish in the SPX, and we think this is a great short setup. Small caps look even worse. Here's IWM, the small cap ETF. You can see they rallied up right into resistance as well. Another great shorting opportunity. What's going to follow the SPX and go lower. Might even go further lower than the SPX because small caps have been relatively weaker against large caps as we've seen in the last few years. And let's move over to gold now. Super popular chart right now. A lot of people have been talking about this breakout of this wedge here. And we still think that gold's going to stop running here soon. That was a pretty big overextended run-up that we had here without a pullback. So we're looking for a breakdown here to get short and ride this back down just because we feel the fundamentals aren't lining up for a gold rally right now. Just because inflation is so low and typically gold is going to rally hard when inflation expectations are high, but we're not seeing that at all. IBB, the NASDAQ Bio ETF. You can see that bios have failed to rally with the broad markets. We didn't get a big, huge rip like we saw in other markets. Instead, we've kind of just stagnated sideways, and this is going to be another great short candidate to hit when we fall back over, especially since it's had a lot of relative weakness here. Euro USD. Okay, there's basically no direction in this chart. We're in a channel. We can't break highs. We can't break lows. This is chop, non-directional chop, and you want to stay far, 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 far away from this. So we're just going to let Euro wait to tell us what it's going to do. Not going to make any bold predictions. It's best just to stay away from this right now. And finally, Bitcoin. We see Bitcoin coin in a nice weekly pennant here. If you have an account to trade it, it's probably worth a trade to the upside as people start to get worried about all this central bank mischief going on. Buy a breakout and let's see how high this guy can go. And that concludes this edition of the Market SitRep produced by MacroOps. Once again, I'm Tyler. Thanks for listening. And if you enjoyed it, feel free to subscribe to our YouTube channel, follow us on StockTwits or Twitter, and check out our Facebook group. It's a great, fantastic discussion forum where we go through whatever we're seeing in the markets. Everyone's having a lot of fun in there. I'll put all the links to all these social things below, and visit our website at macroops.com. Before I forget, I wanted to show you guys our 2 free guides that we've produced. The one on the left is the Macro Ops Handbook. It discusses how we view markets, fundamental macroeconomic and technical analysis, position sizing, risk control, psychological management, and much more. And the one on the right is a beginner's futures guide. So if you're unfamiliar with how the futures market works or how to trade them, we wrote a beginner's guide on that. Both those links are in the description below as well. Thanks for listening. I hope you enjoyed it, and have a great day.